I think you're getting overreactions, but also just a little bit of Main Street catching up with Wall Street. It is going to happen now. So with the higher rates at the long end of the curve, I think we've just started to see the impact of that in the real economy when it comes to financings for companies, when it comes to car loans, credit card loans. The household balance sheets impact from the long end rising as it has is yet to be felt. And that's something we all need to watch for. Doesn't help what happened with the CPI print and also the PPI print a couple of days before that, both above expectations, making the November rate hike very likely. So not only are we going into a rate hike in November, which was priced in but maybe not with as much conviction, is going to be higher for longer, and that is going to hurt. That flow through is going to hurt in the real world.
I think the word conviction is a good one because the market did subtly change its view on whether there's another rate hike coming this year. But has anything actually changed because of the CPI numbers? I mean, the growing risk that the Fed officials were spelling out, and this was from food and oil prices, it was from some of the geopolitical uncertainty, even the growth profile. Has any of this changed thanks to that CPI number?
I think, you know, what's really changed when I look at the data over the last few weeks is that if oil prices are going to be higher for longer, if OPEC's cuts, if the view from OPEC of making sure oil is at $85 plus, call it, a barrel, what happens to core inflation in the flow through, right? That's what I'm watching, that there will be flow through. I think we've discussed this in the past with, you know, price of fuel increasing, and that flows into cost of goods, etc. Because it was the goods inflation that was having disinflationary pressure. Services is very sticky because you can't cut wages that easily, as we all know. So, but now if you've got goods inflation also going up the other way because of the flow through from energy, I think that changes the mix here in the foreseeable future quite a bit.
I want to get to the private equity market because this is an area you're tapped into. I was talking to a big private equity player the other week and he said, look, this is not even going into the financial crisis, the conditions we're seeing. This is the 1990s in terms of some of the credit cost pressures. Just explain what you're seeing and how this is quite different to, say, even the last 10 years.
It is incredibly different because we have two pressures on private equity. On one side, you have financing costs. Leverage buyout requires just that, leverage. And you have leverage markets that have been incredibly tight and or shut, in the case of the syndicate loan market, and very expensive to borrow these days. Now, bolstering that sector away from banks are the non-bank lenders who've stepped in with large funds to provide that underwriting, but costs have gone up. At the same time, private equity runs on a clock, Karen, that they have a 10-year life fund in most cases. You can get extensions, but in those 10 years, you have 4 or 5 years to deploy your capital and 4 or 5 years to sell. Now, most of the private equity financial sponsor community has been on hold since end of 2022, not deploying as much capital as they usually do and not selling companies. That has to change. They can't be on hold forever because that risks their own businesses and what investors expect from them.
I gather COVID got in the way too for a couple of years prior to that, so there was also an impact on that time frame.
Indeed. And after COVID, we had this big resurgence of deal making, and so lots of things got done in 2021. And that gave the market the ability to take the pause that we did in 22 and most of 23. However, now we're getting to the point where investors are saying, you haven't put my cash to work in a deal. It's been 9 months. It's been a year. You can't stay on hold forever. And so now we're going to start to see the markets starting to move, but with increased financing costs, it won't be easy.
So more deals coming.
More deals coming, more green shoots in the M&A market for sure, but it's not going to be linear growth up because of the risk of financing.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.